Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
And then my last example, I believe is my last one. Yeah, my last example here is another couple of bearish spreads where I'm using the PZO, right? And the PZO is another one of these indexes that is based on the Mexican peso. So let's say I'm bearish on the Mexican peso. How bearish am I? Well, I set my strike prices based on how bearish I am. Now this one's a little hard to see. There's a green line drawn right at the top of the blue bar there. If you can see it, right at the very top edge of that teal-colored blue zone, there's a green line. That green line is a support line. I drew that green line as a support line there because when the index came down to that level, 2 days in early December, it bounced higher. It came down to that level again about the 5th or 6th day into January, it bounced higher. And then finally, a little later in January, it broke through. Well, what happens when you break through a support line? It turns that line into a resistance line, right? If you have any belief in technical analysis, you know those simple principles. Well, we have just broken through that support line. And in fact, you can tell by the candle that it actually closed below that support line for the first time on this entire chart. We've got August, September, October, November, December. Not once did it ever close below that support line. It only dipped below it for a short period of time there at the beginning of December, but it closed above it, right? Now we've got 2 days where it closed below that resistance line, which tells me that we're probably heading lower. So how do I capitalize on this index that's now fallen through its support line and has created a resistance line? And just like in the previous example, I want to be short, I want to be bearish in a longer-term downtrend, which I believe we're now in, but in a moment of short-term strength. And that is when I'm just up to my resistance line, which is right where I'm at. I'm just a little bit below my resistance line because I just broke through yesterday. So how do I do this? Well, if I'm moderately bearish, then I could put on a conservative trade, which is the first example, where I buy 126 calls and sell 123 calls. Now these are calls, but this is a credit spread. And remember, on a credit spread, my goal is to bring in the credit now and keep as much of the credit as I can, hopefully all of it. And the way that happens is if both of these options just disappear. They expire worthless and go away. Well, where would this index have to be in order for both of these options to expire worthless? It has to be below the lowest strike price because calls don't have any value if the index is below their strike price. So that means my max profit zone occurs at 123 or below, which happens to be the very bottom edge of that beige zone. And you can kind of see that if you can see where the index is at 124.60. The bottom of that beige zone is right about 123. This is a 3-point spread, 123 to 126. I bring in a credit of $1.26, which means I've got a maximum gain of $1.26, a maximum loss of $1.74. So the max gain's a little smaller than the max loss, which means that my odds of a profit are a little higher than my odds of a loss. What is my break even? The break even is the strike price of my more expensive leg, which is 123, plus the amount of the credit, which is $1.26, or in this case, 124.26. Well, that happens to be the top edge of that beige bar at the bottom. And you can see, in fact, yesterday that this index actually got down and even was in the break-even zone for a short period of time. It didn't close there, but it actually dipped down into that zone a little bit the prior day. So if I believe that this index is heading lower and that it's likely to end up somewhere in that beige zone, then I could make a $1,740 profit if it gets all the way through the beige zone, right? What if I'm not so confident? Breaking out into new lows, just like breaking out into new highs, is sometimes a little difficult to accept. So in this example, I might not be quite so confident about that. So is there a way to make money when I'm not quite so confident of the downside here? How can I take on a little bit more conservative trade? The example here is the one in blue. If I do a credit spread, and my goal in the case of a credit spread is to have both options expire worthless, then that means they need to both be out of the money. The best way to improve my odds that they'll both expire worthless or out of the money is to have them start out as out of the money right from the get-go. And that's what we're doing here. We've got a out of the money credit spread. The index is at 124.60. I'm going to sell a 125 call and buy a 128 call, both of which are way out of the money. This brings in a net credit of 78 cents. This is a 3-point spread, so that means my maximum profit is $780, but it's a 3-point spread, so 3 points minus the 78 leaves me with a $2,220 max loss. And again, just like I said previously, just because I can only make $780, but I'm risking $2,220 doesn't make this a bad trade. That makes it a good trade. That makes it a high odds trade, right? The ratio there is approximately 3 to 1. If there's a 3 to 1 max loss to max gain ratio, that means there's 3 times more likelihood that I'll make a profit versus a loss. And as you can see here, my break-even price is 125.78, which is the top of the blue area, which just happens to correspond almost exactly with my resistance line, right? So when I do the blue trade, all I'm betting here is that this index is not going to break back out above that resistance. It's going to hold. That resistance is going to hold. It's not going to break back through. So as long as it stays below the resistance line, or in this case, the top of that blue zone, then I'll be profitable. If it breaks down below the blue zone completely, which happens to be where it closed at yesterday, it's already in its max profit zone, right? The max profit zone is down below the lowest strike, which is 125. Well, it closed at 124.60 yesterday. Again, I'm talking as if this was January. Then I'm already in my maximum profit zone. So all I need for this index to do is just stay where it's at or go lower. In either case, I'll make my maximum profit. So this is a very conservative trade. Clearly, you can see that it's much easier for this index to be below this blue area than it is for it to be below the yellow area, which is where it has to go in order for me to hit my max profit on the other one. Now, because it is so much easier, that's why the payoff's not so good. That's why I can make $1,260 on the first trade. This one will only make me $780 because I'm playing a much higher odds trade here. I'm doing a strategy that has a much greater likelihood of paying off. And the greater the likelihood is that your trade's going to pay off, the smaller that payoff's going to be, right? It's that standard, it's that risk reward. I'm taking on less risk, and so therefore I'm going to get less reward. If I want to get a bigger reward, I got to take on a bigger risk, right? Now, you might be a technical trader, and there could be all sorts of other technical studies. If you like to look at Bollinger Bands or MACDs or moving averages or Fibonacci's or whatever other technical studies you might be interested in, I'm not really here to weigh in on the merits or demerits of any of those studies. They may have validity for you, and that's fine, and I actually may use some of them as well. What I wanted to do here was to illustrate in using the most simplest of all, what I believe the most simplest of all technical analysis things are, which is just support and resistance. Now, maybe you use a support and resistance line and you can come to conclusions just like I did, but in order to help you decide whether you want to trade or not, you put on another study. Maybe you put on a moving average and say, okay, not only does this look like it's in a period of short-term strength and a period where it's probably going to be heading lower, but it's also below its moving average. You got a crossover going on there, or it's in, whatever, or put on some oscillators, whatever it might be. I'm just trying to make this as simple as I can, mostly because I'm trying to illustrate how you can adjust the strike prices of your vertical spreads, how you can decide whether to use puts or calls, and how you can visually see whether or not a trade makes sense. I have done a lot of trades on paper with numbers and come to the conclusion based on the numbers that it looks good. Then I map it on top of the stock chart and I go, ugh, I don't like that so much anymore, and I don't do it. Because what looks good on numbers may not look good visually on a chart. And vice versa. I've had some trades that I wasn't so sure made sense number-wise, and then I put them on the chart. I'm like, oh man, there's no way that's not going to be, that it's not heading in that area, and it's not going to be able to hit that zone. It'll be real simple.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.